Welcome everyone to a new video, and today we're going to cover something new. You've probably noticed in the past weeks we have been diving into the depths of the videos. We have been talking about networks and how to value them. We have been talking about on-chain metrics, the other hard fork, and today about how to measure inflation in the charts and thus outperform them as well. Because that is what you should be the objective of every investor, and that you should be your goal. So if you can appreciate this, please leave a like on this video and don't forget to subscribe to this channel as well. In addition to these videos, I also went live often this week to discuss both the market and the FOMC with you. So make sure you don't miss this and make sure to join our live streams on Monday and Thursday evening. If you like what we do, our trade ladder and recently added premium membership can be tested for 1 week for free. The links in the description gives you all the information you need and what you need to join for free. Back to today's video, I'm going to explain to you in broad terms how you can start measuring inflation in the charts and how you can see if your investment is smart. The fact is that not every investment produces the desired results and thus only becomes visible when you start measuring it in the right way. First, we're going to question ourselves, what is inflation? By now, we are so far into the market cycle that it is pretty much clear to everyone what inflation is and how it works. In summary, it boils down to the actual following points. The reduction in the value of money, currency devaluation, and inflation, of course, is clearly visible in the price you are paying for your groceries, gasoline, haircut, or other products. The devaluation of your money causes products and services to become more expensive, and that's what we all see happening. In today's video, I'd like to show you a different perspective on inflation. This is because there is a difference in how you can measure it and the relevance of the valuations. To start with this, we're going to look at the image you can find next to me, which is the SPX. In this chart, you can see that the price movement of the SPX is going up parabolically. Normally, this is a huge increase in buying power and buyers pushing the price up step by step. But if we look at the buying volume, we can see that this has only been decreasing since 2008. Thus, the parabolic uptrend is not realized by new buying volume, because with some exception by, for example, the effect of stimulus around Corona, no structural increase in purchasing power is visible. Price appreciation in this case has been realized by the depreciation of the denominator, the dollar. And as the dollar loses value, the price of the asset increases. Asset inflation is what we call this, and this is the correct way to look at inflation. Now we will make the following equation. In the following figure, you see the Fed balance sheet in red. As you can see, a huge increase since 2020, the start of COVID, in which extremely large amounts of money have been reprinted. Now with the start of QT, this increase decreases and you can see a slight reversal. In the following chart, we are looking into the comparison between the rise in the Fed balance sheet and the rise in the SPX. In a world where economic growth is led by the global money supply, growth of assets is almost equal to the growth of the balance sheet. So you didn't make money by investing in the SPX at all. This is the perfect example of asset inflation. You can also see it to the housing market, for example, where houses rose 17% in 1 year. The house did not become worth 17% more, but inflation was actually 17%, and that is balanced out by the rise in the price of assets that in this way are becoming more and more unaffordable for ordinary people. If we then zoom out further, this is the picture of the SPX, an underperformance of 770% against the Fed balance sheet. Investing in the SPX since 2004 due to the currency devaluation has caused its investors to lose money. In the next part of this video, we are going to discuss how you can actually outperform the Fed balance sheet and thus still make money on your investments. Now, step by step, we will add different asset classes to see which asset is relevant at times of balance sheet augmentation. Starting with gold, what we see is that over a period of say 10 years, gold can be very stable in dollar value. But if you change the denominator by the Fed balance sheet, you clearly see that gold has remained flat while the money supply has continued to grow. A loss of purchasing power, or you could say that that's still undervalued at this point. Silver is actually no different, performing even worse in this measurement period, so it could be even more undervalued as well. Now we're going to look at other asset classes, in this case the Nasdaq. In the chart you can see that the Nasdaq is the first that has the potential to outperform the balance sheet. This is because many technologies, like some cryptos, have network effects that create value over time. In addition, development is getting cheaper, and so you are dealing with S-curve models that I discussed in an earlier video. But the QT effect is also evident. The Nasdaq works at QE but not at QT, as it is based on future value. Now we are going to look in the next chapter into crypto. The real differences only become clear when we bring in the crypto industry. Crypto today is the only asset class that outperforms the growth of the Fed balance sheet. This is the outperformance factor we are looking for. And that's why we're also heavily interested in crypto overall. In the net chart next to me, you can clearly see that Bitcoin can experience huge gains during periods of QE, but like the Nasdaq, it is usually susceptible to QT. The difference is that Bitcoin's ratios ensure that network adoption and explosive growth ensure that outperformance always remains above break even, and so Bitcoin is one of the only asset classes that allows for this. The real difference only becomes clear when you bring the Ethereum chart into the equation. If we conclude and we say if you invest to build capital, you should always look at the growth of the Fed's balance sheet. Money creation, which is QE, contributes to the growth of the valuation of asset classes, and in some cases this is not even one-to-one, but the asset grows even less. In short, money is created faster than your asset grows in value. You become literally poorer, and that's what we feel at this point heavily. In our analysis, you can see that there is only one factor that causes outperformance, which is innovation and technology. But cryptocurrencies are the only asset class that does this to great heights. And the Nasdaq has it also with tech companies, but less. So for growing your investment capital, it makes almost no sense to invest in any asset class other than crypto at this point if you want to invest into innovation and technology. So that's the updates for today, and in today's video I've showed you how you can really measure inflation if you focus on the right denominator. Once you have the measurement tool right, you directly see the impact and can look for ways to outperform. I hope this has given you a better view of how to value assets and thus also create a portfolio plan, which everyone should be doing. Thanks for watching to this update. Make sure to hit that like button and subscribe, and also don't forget, don't do stupid shit, stay calm, and I'll see you again tomorrow in a new live stream at 7 p.m. and on Thursday as well. Have a wonderful day, and I'll see you tomorrow. Ciao!